Hit it.
It's Friday, April 23rd, 2021, episode 128. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Vincent Deluard from StoneX. We have a terrific macro discussion that you don't want to miss. We might even figure out what's up with Vincent's inflation obsession. Then Patrick gives us his very best Houdini impersonation and talking charts.
This week in trading history, we look back to the U.S. going off the gold standard, and we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So today we're drinking Salter Street Brewery's It's About Bloody Time English
It's about
Ale.
bloody time.
I chose this one today, and I won't say why.
Okay,
It is about bloody time. Everyone can just guess what it is.
So for something about this beer, this is not a double or triple hopped, rip your taste buds a new one, fruit punch, peanut butter, face pucker kind of beer. You want a milkshake? Then go to an ice cream store. If that's what you're looking for, then move on, my friend, because this ain't for you. But if you're looking for a smooth, great tasting beer with malty notes of caramel and toffee, it's about bloody time.
Yeah. Actually, I was about to say.
I love their like advertising theme or motto there, but I don't know if I like it.
Yeah.
What do you think?
I'm gonna have a few more drinks throughout the show.
It's too
and
caramelly for me. I think.
Yeah.
Okay, side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include, now we got a lot today. It's all from Faraz. Big thank you to Faraz. So we got stake bet psychosis, Tesla shortophobia, the Wagyu withdrawals, which I like a lot, copper conundrums, biotech botulism, Ponzi pink eye. And then I can't remember who sent me this one, but I got to keep it in there. It's the Snoop Doge syndrome.
All right. Okay, let's get on to our interview with Vincent. So we have a great pleasure to be joined by Vincent Deluard. He's the Director of Global Macro Strategy over at StoneX. Vincent, great to have you on the show, bud.
Great to be back. Thank you for having me.
Vincent, it's Kevin here. I see that you changed your name since you've been on the show last. Not you yourself, but your firm. It's no longer. What was the old name?
The old name was INTL FC Stone, and no one could remember it, so we moved to StoneX, still the same firm. I guess the focus is on the execution side and the technology platform.
It sounds like a little bit like something that Fred Flintstone would have decided, but don't tell your bosses I said that. Why don't you tell, just before we start and we jump into this, why don't you tell people about your firm and about yourself? Just real high-level overview, because you have been on the show before. So we can just kind of tell, give us the Cole's Notes version.
Cool. StoneX is an institutional broker-dealer, global financial service firm. We're listed on the NASDAQ. We basically do everything from commodities to securities, stocks, ETF, fixed income, and cash management services. I'm the Director of Global Macro Strategy. I've joined about 5 years ago, and I try to write intelligent and insightful things about the market once a week, which, as you very well know, because you do it actually a lot more often in your newsletter, is quite hard, but also quite rewarding.
No, and I love the stuff. We have so much to to go over. So why don't we just jump right into it? I'm going to start with one of your pieces here where you talk about the great monetary disorder, the new golden age for global macro. I thought this was a fascinating piece where you talked about the fact that in the past, central banks tried to dampen down volatility of foreign exchange. And the way that they did that was through monetary means, meaning changing of interest rates. Now, with interest rates all at zero, this is no longer going to be the case. And we now might see a return of volatility in the FX. If I got that right, and why don't you elaborate on it?
No, you summarized it perfectly. I think, we came from an era of relative stability in exchange rate. I pinned that down to the first G20, which was in the midst of the great financial crisis. And this was really, to me, all the global leaders kind of getting together and saying, okay, we got to fix that. And we're going to make sure we coordinate our actions. And sure, there were some hiccups along the way. There was the taper tantrum. There was Abenomics. There were times when U.S. rates were rising too quickly. But in general, I would think this era of globally managed exchange rate has been somewhat successful. There was an end to the currency war. There was a Sintra Pact in 2016. So central bankers in general have been mindful of each other's action and have tried to engineer some sort of stability in exchange rates, which you can see in the fact that, if you look at the three major exchange rates, the euro to the dollar, the yen to the dollar, and the Chinese RMB to the dollar, we stayed in 20% band for the past 13 years. So every time something got too hot, there was intervention to cool it down. And the tool to accomplish that has indeed been interest rates. Central bankers had been willing to tolerate deviation from what they viewed as the optimal interest rate for their own constituencies in order to achieve global stability. For example, I'm sure the Fed would have liked to normalize faster, but after the taper tantrum in 2013, they waited a little bit. I'm sure the Europeans were not too happy about Powell's rate hikes in 2017, but you know what? Eventually, the Bund also raised 100 basis point, and that ensured some stability to exchange rates. The reason why it's not likely to go forward is an economic theory. Well, not a theory, really. It's a theorem by Mundell, who say that it's called Mundell's trilemma. You can only pick 2 out of 3 things. You can either have flexible an exchange rate target, control over your domestic interest rates, or open capital markets. Well, we're likely going to keep open capital markets. So we really have to pick between a target for exchange rate or a domestic policy consideration. And I think with the recovery from COVID, no central banker in the world would be willing to sacrifice economic growth for domestic priority over the notion of some sort of globally coordinated exchange rate mechanism.
So, for those who don't know, I think that the Mundell, I had to look it up because I had never heard about the Mundell, the theorem, and it actually is also known as the impossible trinity.
Correct.
And why don't you just explain to people what the impossible trinity is and how it works and why that's important now?
Yeah. So this is really something that's at the heart of every balance of payment crisis, and it's a hard constraint for pretty much everybody, developed and developing nations alike. And what it says is that if you're going to have an open capital account, meaning if you're going to allow foreign capital to come in and out of your country, you have to pick between either targeting the exchange rate or targeting your own level of interest rate. So if, say, you choose, let's go with the extreme solution like Hong Kong. If you choose to peg your currency, so you have the absolutely clear target for exchange rate, then you have to import the monetary policy of the country you're pegging to, which is why the policy rate in Hong Kong generally follows that of the Federal Reserve.
Right.
So that's one spectrum. On the other spectrum, you can follow the path of, say, Japan or the European Union, where it's like, okay, we're going to let the exchange rate float because we think it's better for our economy, and we're going to accept some volatility there. But what we want is to adjust the interest rate to what we feel is necessary for our economy. So we'll get our interest rates to 0 or negative, and then God knows what happened to exchange rate. It's not within our mandate. So that's the theoretical framework. In practice, it's more like a spectrum, and central banks, kind of cheat and move along that spectrum. Sometimes they favor currency stability, or sometimes they favor their own domestic priorities. And what I'm trying to explain is that we moved from an era where there was at least some concern about exchange rate stability to an era where the overriding priority is going to be setting up, stimulating the economy as much as possible with monetary policy. I mean, this is basically MMT, if you want. If we, and I believe it's this where we're going, or we already are, if we argue that monetary policy is subservient to the political authorities. It's subservient to fiscal policy. It's actually integrated within fiscal policy. Then that means that the central bank is effectively tied to politicians and has to do what they're being asked instead of trying to kind of run the global show and coordinate their actions with what central bank is.
So in essence, the volatility, whereas before it was in the fixed income market, will leak into the foreign exchange market.
Absolutely. Okay. That is the conclusion. And with volatility, you can, it's like pressing on a balloon, right? You can suppress it somewhere; it's going to pop up somewhere else. And when you suppress interest rates, it's going to move to FX. The last time we had something like that was the 70s, where we also had a global financial order that kind of unraveled, and what followed was a decade of extraordinary currency volatility.
Right. And why do you think that will be the golden age of macro? Like, why kind of walk us through your thinking there, why you call it the golden age?
Because big global macro bets like the kind that George Soros or Stan Druckenmiller would make back in the 90s are going to come back, and this is where you're going to make your money. I think on the prior podcast, I think we discussed the death of the 60-40 portfolio, which now has become the consensus, right?
Right.
If you look at most traditional asset classes, are priced to deliver, I would argue, negative real return for the next decade. I mean, this is what the tips market is telling you. Like, if you buy tips today, in 10 years, you'll have less money in real terms than you put in there right now. Right. I would argue it's probably the same thing with stocks. So if traditional assets are priced to deliver negative real returns, well, suddenly there's a market, the FX market, that has a zero expected gain. Suddenly that's very exciting. Right? When everything is negative, getting to zero on average is actually quite good. And hopefully, because we're going to see all these global macro disorder, if you get the right currency at the right time, I think you'll be able to have massive gains because this kind of artificial cap on currency volatility that we had for much of the past 20 years is going to be gone.
So, Vincent, I happen to agree with you. The market doesn't seem to agree with us because I was just pulling up the Deutsche Bank FX Volatility Index, and it's poking along at the lows. It's the lowest it's been since COVID. So maybe that just means that it's all the better time to buy some volatility.
Yes, I mean, let me stress that this is a secular call that I expect to play out over a decade and not necessarily the next 3 months.
Fair enough. I completely get it. And before we kind of go on to the next topic, I'd just like to talk a little back to the impossible trinity. And I just want to highlight that one of the things is that if you think about China, and we go back to the impossible trinity, which is you can't have an open, capital movement and also control the foreign exchange rate and your monetary policy. Well, that's one of the reasons that China can't actually open their capital account is because they want to control both foreign exchange and monetary policy. Do you think that that's going to change in the coming years, or are they just going to continue to kind of try to straddle those and achieve the impossible trinity?
Eventually, they'll have to let go of the capital controls, and I think they want to do that as well. They just don't want to do it in a controlled manner. So it's going to be a process, not a binary outcome. But the overriding goal for the Chinese leadership is to break away from their dependency on the dollar. I mean, this is China's biggest geopolitical weakness, is that it needs about $600 billion to settle its bills in the big four commodities like oil, soybean, iron ore, and I forgot the last one. So the Chinese economy needs access to dollars in order to feed its population or to build its roads, and that is a problem. That's why, especially when the U.S. tells them, "Hey, we don't want to run a current account deficits with you anymore." So the only way to do that is to let the yuan become not the, but it's a reserve currency in its own right. And you cannot do that if you have a closed capital market. You have to let capital move in or out. Otherwise, no one will ever accept yuan to settle trades if you cannot get them out of the country.
Right.
So they're very aware of that. They're progressively working towards that. They watched the Japanese experiment in the 70s and 90s. They're very careful about not not moving too fast or not letting an appreciating exchange rate ruin their competitiveness. But that is the end game for them. There's no doubt about it. Yeah, correct. I mean, because Japan, the Japanese capital account was open when the Japanese economic miracle was happening, and then the Japanese firms were buying hotels around the world, and the Japanese stock market was like almost half of the world equity market cap. Tons of capital, you know, piled into Japanese assets and created this massive bubble. And it took them, a generation to recover from that because they had overvalued asset prices, overvalued real estate prices, and overvalued currency. And that really cost them, 3 decades of growth. So China has been watching this and learning from this and tried very hard to prevent that from happening. And that's one of the reasons for the capital control. And that's also one of the reasons why, up until very recently, they were very reluctant to let the yuan appreciate. But I think this is all slowly changing. That's kind of the second part of my argument, is that we will see a emerging currency bloc rise in Asia around the yuan in the same way that the great monetary disorder of the 70s created the European monetary system, the European monetary snake, and eventually the euro around the Deutschmark.
Okay, so back with the Japan, the Americans forced them to appreciate their currency when
the Plaza Accord,
the Plaza Accord, and then that sowed the seeds for the bubble, and China. That's why they've been reluctant to take the same path, because they saw how it worked out for Japan and said, hey, it's not working so well for them, let's not do it. So why don't you walk us through, though, of what your theory is? And I see, back to your original thing, that there's going to be all sorts of alpha created from foreign exchange. I see one of your big calls is that you think that Asian foreign exchange is the place to be in the next, years and maybe decades to come. Why don't you walk us through your thinking there?
Yeah. So there is a cyclical argument that's very simple, and I'm just going to skip over it. But it's basically, okay, Asia has won COVID, right? I mean, they had much fewer infection. They controlled the spread a lot better. They didn't have to close their economy, and as a result, we're in a position today where their economies are growing. Everything's back to normal there. Current account surpluses are actually at record high because there's been a huge demand for exports from the West because their economies were shut down, so we had to buy everything from Asia. Reserves are very high. So generally, if you just take a simple macro view, Asia is the only real rates are positive, which is an anomaly compared to the rest of the world. So just based on that, I think you have a case to own Asian currency. The traditional problem with Asian currencies is that they typically have the greatest fundamentals, current account surpluses, reserves, growth, so forth, but they were capped. The Chinese would not let the yuan rise, and as a result, all the other Asian central banks would follow suit. Thailand would effectively, I think it's actually been named the currency manipulator by the U.S. Treasury, and across Southeast Asia. And the reason all these smaller central banks would do that is because they compete head to head with China. So if China is going to do an export-driven, cheap currency manufacturing economic model, they all have to do the same thing, right? I mean, if you're, and again, this is the same logic as we had in Europe in the 70s. Like, when you trade, half of your trade is with Germany, you kind of have to follow what Germany does. I mean, it's the same problematic, maybe even stronger because the relative weight of China is even larger than that of Germany and Europe. All these countries, all these smaller Asian countries have to follow the lead of China. And they did that on the downside in the 90s. So 1994, from 1989 to 1995, the Chinese yuan was devalued by close to 70%. On top of that, the Chinese economy was slowly being open. You had the full modernization from Deng Xiaoping. So you actually had soaring productivity, massively undervalued exchange rate. And that, to me, was the start of the great moderation in the West, because suddenly you had basically 1 billion people working for free. And that model spread out through East Asia. Thailand, for example, in 1997 had to devalue the baht because they could not compete with China. And then it was like dominoes, and it was, South Korea and then eventually Indonesia. And after that, basically every single Asian central bank adopted the Chinese model, repressed the currency, forced the savings, have massive current account surpluses, force the savings into foreign exchange intervention, sterilize everything by buying U.S. treasuries, repress domestic consumption, and then do manufacturing export-led type of growth. And that has been a huge deflationary shock for the rest of the world, right? Suddenly you had basically about half of the world lives in China, Southeast Asia, and Japan. And I would say the most productive half of the world lives there. And this region was suppressing its consumption and subsidizing its production. And they've done that for 30 years now. And I think this model is about to change, and the world's not ready for that.
What are the investment implications of this model? Well, actually, before we go there, why do you think the model is changing?
I'm a big believer that over the long term, demography is destiny, and I would go back to demography. The reason why Asia adopted these policies of export-led growth and demand suppression was because they had a massive youth bulge that needed to find jobs. So if you look at birth rates in China, China especially is a good example because during the Mao years it was the more babies, the better. And then after Deng, suddenly you go to the one-child policy. So it was the birth rate in China were super high all the way up to the late 70s and then collapsed from the 80s to the 90s. So which meant that, a lot of kids were born in China in the 70s and 60s and 70s. So they all entered the labor force in the 90s, which is why China had to devalue their RMB because they had to provide jobs for hundreds of millions of workers. And they didn't have the domestic demand to create these jobs. I mean, this was a dirt poor country. This was actually poorer than most countries in Africa. China was poorer than most countries in Africa in the 80s. So the fastest way to create jobs for a huge youth bulge is to develop an outsized and subsidized manufacturing sector. And you do that by opening trade with the rest of the world, which they did with, joining the WTO in 2000, in the late 90s, and repressing the exchange rate so that your export becomes super competitive so that you can provide jobs to everybody. That was the driver back then. And this is what's changing because guess what? All these people who were born in the 1970s, well, now they're turning 50. If you look at the median age in China, I think it's a little over 40 now versus 37 in the US. If you look at the fertility ratio in South Korea is less than 1. I mean, the demographic transition in Asia has happened at an incredible speed, something that we've never seen. I mean, people thought back in the 70s, we're going to run out of everything because we had too many people. Right? That was the Club of Rome guys. And then what these guys could not model is that Asia accomplished its demographic transition, one which had taken more than a century to do in Europe and the US, in 30 years. So now they have the exact opposite problem. They have shrinking labor forces, aging population, and they don't need this massive manufacturing sector anymore because they don't have young people to give jobs to, right? When you have an aging population like Japan, like Europe, economic growth is not that important anymore because most people are retired. So you'll see that growth rate is going to start falling. The investment rate is going to start falling. Manufacturing export is going to start falling. Current account will go from surpluses, massive surpluses, to deficits. Basically, the exact opposite of what happened in the past 30 years. So I see two implications market-wise. One, the most immediate is that exchange rates, which have been suppressed for 30 years, are going to have to play catch-up. And they'll play catch-up very rapidly. My template, again, is what happened in Europe in the 1970s with the Deutschmark, the Swiss franc, the Dutch guilder gaining more than 100% versus the US dollar in a decade. So that's the first one and probably the easiest one to make money with. The second one, and the most unpleasant one, is that just as the policies of demand suppression were deflationary for the West, the new policy of accepting a higher exchange rate is going to be massively inflationary. We will no longer have massively subsidized manufacturing capacity by the half of the world that lives in the Asian continent.
Okay, so let's take those two kind of investment implications one at a time. I'll start with the currencies. How would you express that view with your portfolio? Would you just go buy Chinese, assets, or would you buy a basket? Would you pick? Walk us through your thinking there.
Yeah, I think in China, the case for Chinese government bonds is probably as good as it gets. I'm not smart enough. There's probably some stuff you can do in the corporate sector, but you have all these issues of leverage. You have a government kind of cracking down on real estate developers. So, I mean, if you don't know the sector well enough, I think you're just fine with that. These would be the last government bonds I would touch. Would be Chinese government bonds. They're the last one who pay a real yield. There is still room for, and you have all four engines working for you. You can get spread compression, you can get lower yields, you're still getting coupons, which obviously you're not getting in the West, and finally you get currency price appreciation. So none of these engines are going to be massive in my view, but all four of them, especially compared to the alternative of buying U.S. Treasuries or even worse German Bund, make it the most attractive sovereign bond in the world, in my opinion. Then the second part would be more for investors that are a little understandably edgy about investing in a country that still has capital control, that has a very opaque financial system, that has a lot of leverage. Maybe the best play is to go outside of China and buy the small countries, because we know that they will follow the policies of the PBOC without the risk, kind of policy risk that you have in China. And the metaphor for me, again, going back to the 70s, buying Deutschmark in 1971 would have been a great idea, but even better, buying Swiss franc or Dutch guilder. That had that. If you take into account compound interest, that actually worked even better. So the small countries that look like Germany, around Germany, did better than Germany in the 1970s. So if we transfer the analogy, maybe the Netherlands is South Korea, and then maybe Switzerland is Singapore, where you have effectively a play on China without as much policy risk.
Okay, you anticipated my next question there. But going back to China, do you worry about the geopolitical concerns? Do you, like, when you're thinking about investing in a Chinese, sovereign bonds, you're worried that it's going to be a situation where all of a sudden the U.S. government will, or even the Chinese government, there'll be increasing tensions that make your investment a risk?
I think that is a worry, but for every asset, not just Asian assets. It's kind of the Thucydidean trap, right? The rising power. How will the U.S. accommodate the rise of China? There is indeed a risk of conflict. If there is a conflict, I think it's going to be Taiwan. Taiwan is the one big issue. All the other stuff like Hong Kong is settled now. Xinjiang, I don't think the West really wants to do anything about it. But I mean, if we're talking a nuclear war between China and the U.S.,
doesn't matter in that case.
Yeah, the value of your Chinese government bond holding is going to be the least of your worries.
Yeah, that's right. Okay, so the second part of your kind of thesis is that we're going to get increased inflation. Why don't you walk us through the investment implications of that increase in inflations that we're about to experience?
Right. So I'm really happy because and so have you. So has Kevin. That it's been a tough time for inflationistas.
That's right. We were getting hammered pretty bad there in the before this kind of new fiscal stimulus kind of took off. We were definitely the butt of a lot of jokes.
Yes, and now it's kind of nice to see that the reflation trade has become the new consensus. we are seeing this this inflation playing out across. You look at the price of lumber, the price of wheat, the price of copper, aluminum, iron ore. I mean, you name it. Most commodities are up 100% year over year. You see the inflation expectations breaking out about 2.5% in the U.S. You start to see it in the CPI too. I mean, we're at 2.6 last month, and I think would have been a lot higher if there hadn't been a one-time negative contribution from rents, which I think will normalize and could add up to 1% of inflation by the end of the year. So I'm still in that reflation camp. I think all the news flow that we're seeing in terms of stimulus, in terms of raising the minimum wage, UBI, all these things are lining up perfectly to create a decade of secular inflation. Investment implication, well, I think we're in the middle of the first stage, which is stocks. Usually stocks outperform in the as you get reflation, right? When it's not too hot, the Goldilocks moment where we are right now, where finally we're seeing some inflation and the market is welcoming it. Oh, we're out of this, and it's very hard to disentangle what is inflation versus what is real growth, right? So right now, we're just going to post amazing numbers for GDP, and we'll be happy with that. But then as inflation accelerates, and I expect that to happen fairly quickly by the end of the year, you really want to transition away from even equities really into real assets. I mean, obviously gold, which has been a perennial disappointment for me and many others. Commodities, maybe real estate. And then you need to start looking at pure inflation plays, which for me are in Latin America. This is a region that is short dollar, long commodities structurally, and where you can still buy dirt cheap assets, including the currencies.
And how would you? Is that just going and buying their equity market, or even just their currency? What would that look like?
Yeah, I would say both. Local. I mean, if you look at the relation between, say, you look at the chart, the Chilean peso versus the price of copper. I mean, usually very high correlation, around like 70-80%, because Chile is the world's largest exporter of copper. And then since COVID, you have this massive divergence where copper prices are at an all-time high, and then the Chilean peso is still about 20% below where it was in 2018. Even more spectacular has been the divergence between the performance of Brazilian real and the price of the commodities that Brazil exports, which are mostly oil, iron ore, soybean, and cattle. If you just run a basic regression model on the price of commodities versus the price of most Latin American currencies, you'd find that they are undervalued by 50 to 60%. So any sort of, local currency denominated asset, I expect will perform well once things normalize.
And Vincent, do you think that's just a function of the nervousness regarding the COVID, the fact that Brazil is struggling with, one of the worst COVID outbreaks out of all the countries, and is that the only reason, or is there something else going on?
Yeah, that is a huge one, obviously, and then politics. People are worried about Lula coming back, and preparing for a Lula Bolsonaro type of scenario, which none of these options are very palatable for investors. But I would stress that people tend to over emphasize politics because it's sexy, right? It's like,
Yeah.
oh, this guy's a socialist, or this guy's is a populist, and it makes for like good headlines. But as far as policies matter, Bolsonaro was supposed to be this great guy who was gonna reform the pension system, and then everybody loved this finance minister, and you know what, he turned out to be quite disappointing, at least for the perspective of the people who liked his economic policies. On the other side, AMLO in Mexico. He was the devil incarnate, right? He was like the Marxists are taking over the country. And I'm not saying that AMLO has been a terrific economic manager, but by the standards of Mexican governments, he hasn't been all that worse than the other guys. Actually, Mexico, for that matter, has, I would say, run its economy very conservatively, especially on the fiscal side. So the big, debt crisis that people expected after the election of AMLO has not occurred.
Don't talk too much about Mexico, because we're going to get there, and I want to ask you about your latest report. But before we get there, gold. Do you have any theories as to why it's been such a disappointment?
The only two things. One is real yields. I mean, as we've seen this big backup in yields, obviously gold is typically negatively correlated to yields. Now we're seeing yields give some of that back, so I think that's a nice setup for gold, especially as, if I'm correct, we'll see inflation accelerate, so that people will realize that the increase in yield that we went through was just an increase in inflation. Real yields have actually stayed flat, if not went down, but for now it feels, yields are going up, so I need to sell gold. And then the second one is obviously Bitcoin. It's the millennials gold. I think it's diverted flow from gold into crypto. And again, I'm going to look like a total idiot, I'm sure, by saying this, but maybe the Coinbase IPO was the top. The way the Blackstone IPO was the top of the 2007 cycle. Maybe it is like we're seeing some sort of regulatory crackdown on Bitcoin. So if we see the crypto bubble deflate, I think some of that money goes back into gold.
I don't know if it's going to be the Coinbase or the Coin IPO or the Dogecoin weekend. The Dogecoin. I don't know if I can say that right. I'm not supposed to talk about it though, so I got to go on to the next subject. Why don't we bring up here? I love the title of your latest piece. It's called "Surfing the Blob in Europe and Mexico and Hedging with Anti-Fragile Assets." What's your thesis there? Tell us about it.
Well, let me start maybe with the blob, which you're based on the west coast of Canada, so you.
Well, no, we're actually East Coast.
Oh, you're Toronto.
Yeah,
okay,
we're Toronto. Well. We're not Vancouver. Nope. I wish we were.
I'm sorry for you, man. So the blob was a body of warm water that was kind of floating around in the Northwest Pacific a couple of years back, and it just wouldn't cool down, and it brought a bunch of climate disorder, right? It rained in Los Angeles, which people don't know what that is. Seattle had some sun, really weird stuff.
Both cities were extremely confused by that weather.
Yes, and there were a couple of bad winters in BC, I think, snow-wise, and all these was because the Pacific Ocean was abnormally hot and wouldn't cool down. And I use that as a metaphor for, we have this blob of liquidity, and I think you have like two drivers for it. One is the one I briefly hinted at, which is these Asian surpluses. It's been going on for a long time, right? As we repress the value of Asian currencies, you have all these extra savings that are kind of like floating around, going from one asset to the next. That was the original blob. And then on top of that, you have a much larger blob, which is the central bank blob, where, central banks have been printing these. I think, where are we at? 10 trillion. I think if you look at the G10 central banks, I think we're at close to 10 trillion in central bank balance sheet expansion at this point. And it's not really making its way into the real economy, right? That's the challenge, and that's one of the reasons why inflation has been so slow to pick up. Is despite all this money creation, it's kind of stuck in the financial system. And what it does is that it goes from one asset class to the next. And it's not the normal pattern of bubbles where, you get a bubble and then it corrects and then you have capitulation. No, the blob moves, goes away and picks something else, but things never really correct. So you saw the blob in, electric vehicles, you saw the blob in crypto, you saw it in big tech before, reopen stocks at one point. And it just keeps rotating, and seems with increasingly rapid pace, like almost a frantic, what is the next big thing? Like, well, what should I buy? So I don't really have a view on what would happen to the places that received the blob in the past. Like maybe crypto keeps going, I don't know. But I think what investors should focus on is, okay, where is it going to move next? And I would single three areas for that. One is Latin America and Mexico especially. I know we'll talk about this later. Two is Europe value and reopening plays in Europe. And then three is precious metals.
Okay. Which one would you like to hit first? We already talked about Latin America, so why don't we get into Mexico? Why don't you tell us why you think it might be the kind of recipient of the next blob of liquidity?
Right. So I think 2021, you have three major stories that will dominate the investment narrative. One is the U.S. consumer, right? We have a U.S. consumer that's turbocharged on steroids. People are generally, savings balances are up after COVID. Credit card debt payments are down. Job market has come back roaring. The real estate market is on fire. And then on top of that, you add, $2 trillion stimulus on an economy that's already overheating. I mean, we will see amazing numbers from the U.S. consumer, especially as we get the vaccine rollout and all of that. So that's one story. Second story is steeper yield curves. So we're still anchoring the short end at zero, but we are finally allowing long rates to rise a little bit. And then the third story is reflation and a rally across the commodity complex. Well, Mexico is at the core of all three. Right? I mean, if the U.S. consumer is going to do well, that's going to be good for Mexico. And Mexican exports to GDP is about Mexico exports to the U.S. about 50% of GDP. So Mexico probably has the most leverage of the U.S. consumer of any economy in the world. Also, there's just the remittance channel, right? You have a lot of Mexican workers in the U.S. that send money month after month back to Mexico. This is already up 20%. And these are people who will benefit from the stimulus checks. So you'll see an upsurge in remittances, which will help the domestic economy and also the exchange rate because people need to sell dollar and buy peso. So huge play on the consumer. Next, the yield curve. Mexico is a very, very much like a typical emerging market index in the sense that the largest holdings are, energy and banks, right? So when yield curves are steeper, banks do better, and mechanically, because of the weight of the index, that will help the Mexican index. And then the last play is reflation and commodities. So Mexico is obviously the energy sector is deeply troubled in Mexico, but there's this windfall, right? I mean, it's like an accident that's not going to happen. Everyone expected Pemex to go bust or to create some sort of a budget problem. Well, with oil prices at in the 60s, that we can postpone that. So that's something we don't have to worry about anymore. And then you have all the other stuff that Mexico exports, things like silver, precious metals, even agricultural commodities that are all benefiting from this rapid reflation. So Mexico is, to me, at the intersection of the three major themes of 2021, and it gets in there with a very cheap currency and its first current account surplus in 30 years.
Oh. I'll throw in another, I think, secular tailwind to Mexico in that before China joined the WTO, Mexico was going to be the cheap labor for the American economy. And then when China came along, it stole a lot of that manufacturing from Mexico. I'm wondering if with the increased tensions between China and the U.S. that maybe Mexico will come back as the backyard manufacturer for America.
Correct. And that is especially the case, so there's the trade tensions. By the way, the tariffs are still on. I mean, Biden has not removed the tariffs on China, and it's not clear that he will ever. So I don't expect to see much of a change in this trade dispute between China and the U.S., which benefits Mexico. But beyond that, there's the argument that I was making earlier about in the next decade, Asia no longer subsidizing its manufacturing sector because the demography has changed, and that means that the competition for kind of low end to middle end manufacturing is certainly going to be a lot more favorable to Mexico. If you look at the graph of labor costs between China and Mexico, I mean, Mexico has been flat for 10 years. In China, it's been rising at 10%. And now it's actually more expensive. I mean, depending on which sector you're looking at, but if you take into account transportation cost, it's probably more expensive to produce in China than it is Mexico. And it will keep being that way, especially if as I expect, we see a massive revaluation of Asian currencies.
So that's great stuff. Can you just buy Mexico across the board? Stock, bonds, currency, like the whole 9 yards? You think they're headed higher?
I would think so. I mean, this is a story that will impact every asset class. And again, generally Mexican assets are fairly cheap. I mean, equities have rallied, but in my view, they still have some way to go. If you look at fixed income assets, you're still getting quite a high yield, so you can play it across the spectrum.
Okay, the next part of your piece here, and this is something that I've been thinking about for a while. You conclude that Europe has reached peak COVID despair. I'm extremely interested because I've been worried that the market will start to see through it. Even though I think that COVID might get worse in Europe, the market will start looking through it. And I take it that you came to the same conclusion.
Yes, so I actually just came back from France. I was there for 2 weeks. It was an odd time to be in France. The plane was empty. Technically, I could not have left a 10-kilometer range around my house. I needed to have some sort of a piece of paper. Everything was closed. And Paris without the cafes and the restaurants and the museums and the art. I mean, it's just like a messy, ugly version of any American city at this point.
Okay.
So obviously the mood was very, very grim. It's been and again in the U.S. Maybe Canada is a little in the middle, but Americans don't understand how hard the lockdowns have been in Europe. They complain about, I don't want to wear the mask. Well, how about like being stuck in your house for months, with everything locked down? And that basically, stop and go, right? I mean, okay, lockdown, then we open, then we lock. This is like lockdown number 3 in Europe. I mean, people are just like, I mean, they've had it. Like so this is why I was referring to peak COVID despair. At the same time, things are going to get better. Yes, Europeans have messed up the vaccine rollouts. France, especially. I think Canada did the same thing. We went for the slow rollout.
Yeah.
Whatever. But eventually, we the government kind of corrected its mistake, and you can see that basically the European vaccination program is tracking the US with about a 1 month lag. So the new death, the hospitalization, the new infection, all that starting to plummet in the US about 1 to 2 months ago. So this is going to hit in Europe. We also just the weather, like the same way that last year infections, it was really bad in March, April, and then we had a normal summer in Europe because people got out again. And then finally, of course, these political considerations. I mean, let's never forget that COVID is very sensitive to election polls. France is going to get into an election next year. Italy and Spain is going to be the next year or the one after. I mean, holidays are a vacation. Holidays are religion in Europe. Like there's an economic weight about 10 to 15% of GDP is linked to tourism, and then there's you cannot take away the month of August for, you'll get a revolution in the street. And politicians are smart enough. So I think one of the reasons why we had these very stringent lockdowns in Europe in the spring was that so that we could get the numbers to look a little bit better by the end of May, and then be like, okay, great, we reopen and save the tourism season for the summer.
Okay. Now, so given that, what you think that the worst is in the market, and that are you buying European assets or are you shorting fixed income? How are you playing this?
I was looking at some of the reopening plays. Again, it's not like, to be entirely honest, I prefer the Mexican idea. But obviously, no portfolio manager is going to go 100% long, 100% portfolio in Mexican
So
assets.
this is just a tactical, observation that you think that the worst is in the price already.
Yes, and if you look, I mean, generally there's a strong correlation between the performance of sectors in Europe and in the US, but there's a gap that opened. I mean, first of all, in general, the US premium or the European discount is at record high and has been there for a long time. So generally, if you care about valuation, Europe is probably the better place to be. And then, especially if you look at reopening plays, things like hotels, airlines, restaurants, I would say the US has rallied an extra 30 to 40% compared to the similar European plays. And, if we're just talking about a difference in months, which I think is correct, like, Europe is going to be like the US with a 2-month lag, it does not justify a 40 percentage point difference in the price. So, look at, for example, how Accor, the French hotel operator, is trading compared to like Hilton or Marriott. The valuation gap is enormous, even though they're kind of the same company. Or if you want even more leverage, I would recommend playing it with Spain. Spain probably has the most leverage on the reopening in Europe. It's also going to be the biggest beneficiary from the EU recovery fund. They're going to get about 10% of their GDP in direct fiscal stimulus from Brussels. And then finally for Spain, another thing that I see coming is in the same way that everybody from New York is moving to Florida, Spain could benefit from Brexit and from work from anywhere.
Interesting. At the end of this piece, I'm going to bring it back to Asia just quickly because there was a little sentence here that I loved. And he says, as I explained in the 2 portfolio adjustments for the post-COVID world, Japanese assets are a great way to diversify U.S. and tech-heavy global equity portfolios. I think that a lot of investors are always looking for ideas that, to diversify away from, as their U.S. stocks have done so well and it's become a larger and larger portion of their portfolio. They're always looking for something to diversify into. You think Japan might be that?
Yeah, it has been that for a long time, actually. Just people don't care about it. But if you look at a chart of the Topix or the Nikkei, I mean, basically nonstop bull market since Abenomics since 2012, and then breaking major major resistance level. I mean, 40 years. When you see a market finally break a 40-year bear market, that probably means something. So yeah, it has been, and what I like about Japan is it kind of dances to its own tune. The main driver, there's a supply and demand argument in my mind in favor of Japan. In the US, we're seeing very negative trends here. We're seeing massive issuance of stock, whether it's a SPAC or the IPO boom or stock-based compensation or insider selling. I mean, you're seeing a lot of stock being sold and corporations not buying anything, like buybacks have not recovered very much, for example. So you see more shares being sold. In Japan, it's the exact opposite, right? Because you basically the IPO market has been dead for 20 years. No one's gonna be, I'm gonna go list in Tokyo or something, So you have buybacks. Actually, most Japanese firms, there's been a corporate governance reform movement that has led to most big Japanese corporations do buybacks that are comparable to the US, but you don't have any issuance, and then you have a structural buyer. I mean, every month the Bank of Japan goes and presses a button and buys a Nikkei and Topix linked ETF, to the point now where I think they own close to 10% of the stock market. You also have the central bank buying effectively half of the sovereign bond market. So it's not that crazy to think that in 10 years we'll run out of Japanese assets.
Well, there you go. For people that are interested in diversifying out of the U.S., there's an idea. So the last topic for today, and I groaned a little when we were talking about it, was ESG. And I don't know about you, I find ESG, my eyes roll over whenever I see it on TV and stuff. But you promised me when we were chatting earlier today, you promised me it was going to be the first fun discussion of ESG that's ever been on financial news. So why don't we jump into it? What is your theory on ESG, and what is your kind of unique take on it?
In general, I think the movement has good intentions, and I respect the people who are in it. But I mean, it's gotten to a point where it's ridiculous. Like you've seen the launch of I forgot the ticker now, the BlackRock Carbon Transition Readiness ETF. I think it was the most popular ETF launch. Got like close to like 1.5 billion on launch, and you look at the holdings. What is it? Apple, Microsoft.
I know it.
Facebook,
It doesn't. It barely looks different than the S&P 500.
It's the exact same. No. There's an important difference: the management fee.
That's right. they don't charge you the 7 basis points or whatever the ETF is, or 2 basis points that they charge you for the SPY. They charge you 50 or something. What is the numbers? Do you know them?
I think it's around 15. I'd have to check.
It's still low,
but it's significant. It's still low, but significantly more expensive because now you get basically zero basis point management fee on index funds. But so I don't want to talk about this gimmicky stuff because we all know it's a joke. I think there's 3 issues that I highlight that the ESG movement needs to wake up to: jobs, taxes, and competition. And these have been 3 blind spots that have been completely forgotten. So on the job side, I ran a basic analysis. I aggregated the holdings of the 20 largest ESG ETFs, and then I looked at the 15 most overweight versus the 15 most underweight stocks. And what I found is that the 15 most overweight employed only 1.5 million people, while the most underweight employed 6 million people. And that is, by the way, that is a that's a feature, that's not a bug. It's because ESG structurally over allocates to big monopolies in tech and pharma. So places that have a very high market value, but actually very few employees. And you can think of it, right? I mean, how is like the environmental impact of Microsoft? Like, what's the cost of servers? Like, obviously, by structure, the way ESG rating work is going to reward companies with almost no physical footprint and as few employees as possible. Because if you don't have employees, well, you don't have sexual harassment, you don't have discrimination, you don't have lawsuits, and so forth. So there is this bias in favor of like high value added, high intangible assets monopolies. So that's the first issue. Um, not just focusing on the quality of jobs, but on the quantity of jobs. How do we make sure that capital is directed to companies that will actually provide jobs instead of automate things or rely on algos and robots? Second issue is taxation. So I ran the same analysis and I found that the higher your ESG rating, there's almost a perfect inverse correlation between ESG rating and effective tax rate. Even though on average, companies with a high ESG rating tend to be more profitable. Like there's a quality bias to ESG. Like they generally identify companies that have higher margins, more resilient balance sheets and so forth, but they also pay little taxes. Again, it's the same issues because you go into these big tech monopolies or financial networks like Visa or MasterCard or big pharma where the biggest asset is IP, right? And IP is very hard to tax, right? Because you can, you set up your IP in a low tax jurisdiction like Ireland or the Cayman Island, and then you can escape taxation altogether. So again, I think there's a huge contradiction between the message of ESG, or like, oh, we want, all stakeholders, we want, capitalism to be ethical again, and the fact that effectively it just allocates money to monopolies that cheat taxes. And then the last question, was kind of embedded in the first two, is competition, which I view as one of the biggest socio-political issues of our time, is the concentration of the US economy around a handful of monopolies that have acquired an insane amount of not just economic, but also political power, and the death of competition. And as ESG effectively rewards companies with very large moats, like things like Microsoft, things like Apple, things like Visa and MasterCard, we're actually making the problem worse, not better.
Vincent, I see on your piece here, you talked about the two most eye-opening books I've read on about the U.S. economy in the past decade were, I don't know how to say this guy's last name, T. Philippon's, I guess, The Great Reversal, How America Gave Up on Free Markets, and D. Hearn and J. Tepper's The Myth of Capitalism, Monopolies and the Death of Competition. Are they that good? Do I have to go buy those books?
I recommend it. They're excellent. And again, this is something that I think has flown below the radar in the political debate. But we have, ultimately, I think I blame it on antitrust enforcement. In the early 80s, there was this concept called the Consumer Welfare Standard, whereby, under the old logic, Sherman Act and so forth, just being a monopoly was enough to warrant an investigation. So you had very active monopoly enforcement. And then starting in the early 80s, regulators said, no, you need to show that the monopoly is hurting consumers. And that's a lot harder to do, especially if you have a big tech company where, the product is free, quote unquote free. It's never free, but, at least it looked free. So we had this massive, since that standard was put in place in the early 80s, complete collapse in antitrust enforcement, and at the same time, massive concentration. And people think about big tech, and clearly it's a huge one, but it's not just that. It's airlines, it's cable companies, it's telecommunication, it's banks. I mean, every sector of the U.S. economy, and I would argue even its politics via political donations and lobbying, has effectively become causalized in the past 30 years.
Okay, so in terms of the ESG, you've sketched out the reasons what you think is wrong with it. Are there any investment implications, or is it just a matter of maybe this isn't as good as we all thought?
I keep going back to my inflation idea, and maybe it's an obsession.
You and me both.
Is.
You and me both, Vincent. You and me both.
So I think there is an inflation angle to what we talked about. One is ESG is a real force and it's here to stay, and it's starting to change the way people allocate capital. I mean, the traditional fossil fuel sector has become uninvestable for a lot of investors. And to me, that means that the response function of E&P and energy companies to oil prices has become a lot slower. For example, if you look at the rig count in the US versus the price of oil, up until this year, usually it was a 3-month lag, right? As if oil prices rebounded, 3 months later you'd see new oil rigs being completed. This doesn't happen this time, and I think in some ways it's because no one wants to touch the sector. So I think and same thing, like if we want to do this ESG revolution, this Green New Deal, I mean, the amount of investment that's going to be required is massive. I mean, you talk about like changing the grid, you talk about re-engineering buildings all over the country. So maybe over time it'll be deflationary, but at least the first stage of this transition is going to be massively inflationary. And then the second angle, which again I go back to my inflation obsession, is the concentration of the U.S. economy around big monopolies I think is very inflationary. I mean, what is the point of building a moat around your business if not to raise prices later? So to me, we have a lot of like trapped inflation in the concentration of U.S. industries in these big monopolies. If Netflix doubled its price tomorrow, they could very easily. If Google wanted, they have a monopoly on AdWords. So you have all these trapped, it's almost like trapped kinetic energy, if you want, that's sitting in there. People haven't noticed it because the big tech firms did not need to raise prices because they were already making money anyway, and it was so easy to raise capital. But if I expect the environment change, which is we are starting to see rising wages, we are starting to see a rising velocity of money, then these are companies that have a lot of pricing power that they haven't exercised yet, but they will exercise it.
I like it. That's a unique take on it. Great stuff. Okay, we're at the end of the interview, but before we let you go, I'm going to ask you, we always ask the guests a few questions, so and I didn't warn you, so I'll just throw them out there, and hopefully you can adapt and think on the fly. You do such a good job of it anyways. So first of all, your favorite investing book?
I would have to go with The Prize by Daniel Yergin, which is about an 800-page history of the oil market. And you're just looking through the lens of the oil market. You see geopolitics, you see economy, I mean, it's amazing how oil has been at the center of the really human life for the past 150 years. And obviously this is, someone who's followed the market for, all his life, and extraordinarily insightful.
That's awesome. That's a great pick. Very unusual. Okay. My next question for you is I'm going to put in traders / portfolio managers, or investors. Are they made or born?
That's a very existentialist question here.
Well, you're French. You should be used to these kind of things.
I'm going to go with Simone de Beauvoir Simone de Beauvoir. On ne naît pas femme, on le devient. We are not born as women, we become one. So I don't know. I like to believe in human agency and the possibility of people to forge their own path and learn from their mistakes. So I'm going to say they are trained, not born that way.
I like it. Okay, now the last question here. It's a tough one. You're in San Francisco, am I right? Correct. Okay, so you have to give me. And did you used to live in Paris? Is that where you're from?
A small village in Burgundy, but I studied in Paris.
Okay, so you have to give me something that San Francisco does better than Paris, and then something that you miss terribly when you're living in San Francisco from Paris.
Something that I miss terribly, it's going to be cheese. Stinky cheese.
I thought it was going to be smoking cigarettes everywhere, but okay. Stinky cheese. Okay, and what does San Francisco do better than Paris? And you can't say the stinky sidewalks from all the excrement.
Something.
There's got to be something that's just like, wow, this is awesome. You're not doing very well. You're
I like.
going to
Okay,
get kicked out of San Francisco at this rate, Vincent.
I like the geographical setting of San Francisco, the proximity of the sea, the mountain biking. Generally, nature, I think, has been more generous to San Francisco than it has to Paris. But I would say Paris has compensated with, culture and what humans have made of it.
I got it. You have to go. Have you gone to Muir Woods? That's
Yes.
It's not named after me. That's not me, but but it's wonderful in the redwoods, and it is beautiful, the nature and all the beautiful things about San Francisco. Okay, Vincent, why don't you tell people where they can find more about you and your firm, and give us the whole spiel.
Cool. So, the firm is StoneX. If you want to subscribe to my work, I guess the easiest is to go on Twitter. My handle is Vincent Deluard. I have a link to a trial page where you can sign up for a 1-month trial. It's free. I write 4 times a week, usually about 8 to 10 pages. And then as far as the firm goes, we trade everything. We are the largest firm you never heard from. We focus mostly on kind of middle market, which are not service right and quite often ripped off by big banks. And I think we give them a better deal.
Okay, Vince, I'm going to help everyone out, though, because you went really fast with your French accent, and we're not all, growing up in the 2 languages. Your Twitter, go real slow for our Americans that might have had a little trouble with Deluard. Spell it all out, or I'll do it. Vincent is Vincent, and the last name is Deluard on Twitter. Vincent, it's been a real pleasure having you on. I really appreciate it. We'll look forward to hearing from you next year. Thanks again for coming.
My pleasure. Thank you very much.
Okay, Patrick, or should I say Harry Houdini? What do you got for us?
All right. Well, let's start off with going through the top 3 things we were watching last week. And so, number 3, we were talking biotechs. There's a bet that we're going to settle up on this afterwards, but let's save that for later. But we were just asking whether this was a turning point or not in the biotech index. And so far, it's been working its way higher. I wouldn't say that it's a definitive breakout just yet, but it's been progressing higher, and not even Biden's little capital gains thing could break the stock down. Now, but number 2, we were talking about the ECB and the Bank of Canada, but it was really the Bank of Canada that
they stole all the action.
Yes.
ECB was a snooze fest. They didn't really do anything, but the Bank of Canada came out, they tapered. And not only that, they walked forward guidance in terms of the first rate hike. Yeah. First, probably the most hawkish central bank out there.
Yeah. And then the number 1 thing was that the end of the bond bear market. I mean, that's a pretty big macro call for us to do on a week over week, something to watch. But in one way or another, over the last week, nothing has really dynamically changed, right? So the 10-year yield continues to back down a little bit. Anything that you noticed in the bond markets that's worth noting?
No, not really. It's grinding lower in yield. It's got kind of snooze fest. There's not really much going on.
All right. So let's talk about the top 3 things to watch next week. And next week, one of the things I wanted to start just talking about is the U.S. dollar CAD, right? And so when we look at the, obviously the Bank of Canada came out and with a very hawkish. Were you the one commenting that it's one of the most hawkish central banks out there now?
Yeah, I might have even written a piece. This goes into your little.
Oh, that's right. You know what? Yeah, you might have
actually read that one.
No, I just read the headlines. I just went and looked at the picture. But the thing is that the interesting part that I'm curious about is that will we see this reflect in a bigger currency move? Obviously the Canadian dollar has had a tailwind here. Let me just turn it upside down and let's look at the CAD versus the USD. Just so we're looking at the Canadian dollar trend, and Canadian dollar has been very strong, but a lot of that I think was attributed to a very robust commodity market. And generally, it's a commodity-based currency that does well. But I'm curious whether or not we're going to see relative strength in the Canadian dollar now relative to the other kind of cross currencies. And more importantly, will we see that break out to a higher high and see this resume trend? You think that's in the cards here?
I don't know, Patrick. Part of me thinks that no, that was the best they have, and from here, all the news is probably going to be on in terms of versus expectations, more dovish. But having said that, looking at this chart, and this is talking charts, it sure looks like an uptrend to me. And you put one of those fancy, I don't know what you guys call them, those big trend things.
The trendy things, yeah.
Yeah. What do you do there? You
mean a trend line?
Yeah,
like a line
some
that
guys
connects
use
the
fancy, like the shaded thing. I don't know.
Oh, you mean like
what?
Fibonacci's and stuff?
No, not that. Like, so that you can see the upper and lower parts. I guess you can make two trend lines, and
and then you create a thing. But it is definitely an uptrend channel. That is there. It'll be really interesting to see whether or not that reversal candle that came in the middle of the week follows through. I mean, we were stuck in almost a 1 month trade range throughout most of April. Basically, let's say between 79.5 to 80 cents, a 50 pip little range. Starting to try a breakout. It'll be interesting to see. Okay, so
Patrick, the fact that we put this in our top 3 things to watch means it's definitely going to do nothing. It's just going to chug around in there.
All right. Number 2, which was the big news that came out in the middle of the week, but announcements coming next week, the capital gains tax. Do you think that this is going to be this has now been fully priced in, or do you think there's still a market impact?
I'm not sure, Patrick. There's a lot of details. The market might be assuming something that doesn't end up occurring. I still think it's going to be something we should be aware of as these negotiations go on. We could see more headlines that definitely affect the market.
Right. And so number 1, we had to talk about copper. The number 1 thing we have to ask is, why did you sell your copper in the first place?
I know. There we go. It's barely a new high, and I missed it.
It's not even actually on the futures market. It's not a new high. Well, I guess this is.
And I think I timed it pretty good, and so I'm probably not quite even. Maybe I'm out a little bit, but I've saved myself 2 months of watching it. Now the real question is, do I need to get back in?
Yeah,
and that I don't know.
And
so Patrick, if you know, why don't you let me know?
Well, it has been one of the stronger things outside the grains and lumber, which have been running like they stole something. We'll get to those charts in a moment. But copper has in the last 2 weeks, or even really the last kind of like 6-7 trading sessions, has just had day after day of accumulation, working in a trend higher. And even though oil and other things have been very range bound, copper is just getting the buy orders. It's just working way higher. If it breaks to a higher high, 475 is an easy target.
I'm so scared, Patrick, because I do feel like when I'm not long it, I feel like a little bit like when I don't have any gold. Like a flat position is like short for me.
You know what? Just throw on some option positions, maybe on some copper producers, and just take a neutral sense. Not neutral, but like just get something. Anyway.
I don't know. I do feel like that if it goes, and I will have been penny wise, a pound foolish, and so I do worry about that.
Well,
but then I know that if I chase a breakout, it's definitely gonna prairie dog.
Okay, the way I would put it is that in my view, the easy money from like 2.25 up to 450 has already happened. We're now talking about whether or not there's an extra 50 cents.
I love that. I love that expression, the easy money. Why didn't you tell me when it was the easy money? I would have taken the easy
I'm just
money.
Saying that. I'm just saying.
I'm not blaming just you, because a lot of people say that, and it always seems like it's always in hindsight, it always seemed like easy money. It was never easy. Is all.
Hey, my members were buying Freeport at $8 a share. Okay, buddy. So
I know, but I'm just saying it wasn't easy. It wasn't easy.
No, but I'm just saying that okay, let me put it this way: copper doubled in the last year. Do you think copper can double from here in the next year?
It might. I don't actually think that is as crazy sounding.
Oh my God!
You
are like inflationista. Why don't we just get all you French? All your French buddies here. We'll get Gav and Vincent back on here as well. And
I don't think Vincent, the other Vincent, is quite as bullish as this Vincent in terms of inflation.
Yeah, there you go.
The two Vincents are duking it out, and they're both on the West Coast.
Yeah.
Okay. Anyway. So what do you got here?
So let's just talk the rest of the charts. Well, while we're there, why don't we just start with looking at the copper miners themselves, right? So let's go to that COPEX. Just since we're on the theme, and you can see.
Can I interrupt for a second? Just I'm sorry, Patrick, but
Oh, I'd love you to interrupt. Please.
I know you always like it when I do this, but I feel like it's needed. You have a red list. What the hell, man?
Yes.
Has no one what kind of trader are you that you have a red list of stock listings there? You have all these different colors, right? Like, show us your colors that you have. I saw the bright thing.
Yeah, blue, green, orange, and purple.
What the hell, buddy? Red?
Yeah, but red is the ones that I have permission to erase after I'm done the show.
Is that what it is?
Like I red list the ones I'm going to talk about here.
I don't know.
On the show.
I just feel like you shouldn't have any red on there. And
you know
I'm
what?
Gonna, I'm going to ask that you come up with a new color next week.
And you'll never go onto a 13th floor of a building. Come on, stop.
No, I like
stuff.
13. I think 13 is actually lucky, but red is.
Stop it.
Okay,
just stop. Okay, I like red. It's a very nice color. It works well with me.
I don't like it in my inventory. Okay, keep going.
All right. So anyway, but just looking at the copper stocks here, it does look very bullish. I mean, it's like the copper chart. I mean, at this stage, a breakout here in copper could send this to $45, $46. And watching, all of them, like Southern Copper, Freeport McMoran, Ivanhoe Mines, all of them, they look great. It's worth watching. So I wanted to go and check out some of the other things. Like, for instance, obviously the S&P 500 has been doing well. And the NASDAQ has even participated. But one of the places where there's been lagging has been the Russell. And we've been talking about whether or not the Russell was going to break down, whether all the technicians that see head and shoulders patterns in here, they're calling a top. But what's interesting here is that with this breakout, we saw a little bit of rotation coming back into these. And even like, for instance, one of your favorite little places, like, for instance, KRE, which is the regional banks, have been, a month of consolidation, certainly have not been where the money flow is going. It'd be really interesting to see whether we're going to see a breakout back into this space. Now, one day doesn't make a new trend. I'm not making the bold call that I'm predicting that it will, but I definitely think that's something to watch next week, whether finally these kind of small caps and regionals and all these things start getting some of the money flow.
God, you goochered my trade again.
Okay,
I was actually thinking yesterday when the tax came, I thought to myself, oh, this is it. I bet you we're back to the, they crushed the small caps. I said, I bet you this is the time to buy it. And then today, it outperformed.
All right, so I'm going to just not say anything else. I don't want to gooch or anything. Okay. So the next thing I wanted to talk about here is the dollar. And I've shamelessly been bullish the dollar, and I'm asking the question as to whether I've overstayed the little bounce. I was buying the dollar all since the start of the year. But you know what? I'm a little disappointed the way this has just been a systematic amount of selling in the last month. Just every day, it's weaker and weaker. But now, forget the dollar for a moment. So the dollar's been very weak. But one of the things that I'm watching, just going back to the red list here, Kevin, was is whether or not that will be a tailwind for the emerging markets. We have a very oversold China market, a very oversold Indian market. A lot of the Brazilian market has been rolling back up, and emerging markets seem to be rolling. And if the dollar is not as bullish as I wanted it to be, the question here is this the moment where emerging markets are breaking out?
With the dollar going down, I get it. I hear what you're saying. Patrick, maybe. I'll tell you what I'm worried about, though. I think that I was on it when I was talking about the TGA, which is the Treasury General Account, and the fact that they were emptying this. And I think that all of these trades is directly attributable to that monster sea of liquidity that is basically started a month ago and it's still got another, month to go or something like that.
Yeah.
And I think that the danger is reading too much into this. I'm not sure you were right in terms of, I'm not sure you were wrong in terms of your bullish dollar call, US dollar call. But I think what happened is that the TGA kind of emptying has temporarily paused it.
Right.
So I'm not saying you're wrong
so
in terms of the emerging markets could rally from here, but I'm just saying that be careful because
what's the time frame for the whole TGA thing to play out?
I don't know the exact I don't know the exact timing, but I do know that the biggest part of it is already done. Like the point of maximum emptying has occurred already.
Right.
Like I'm just gonna pull it up here while we're waiting here. U.S. Federal Reserve General.
I'll tell you what. I'll go to the next charts. You look it up while we're doing it. And we'll circle back to it. What I wanted to touch on was the grains, because this is outside of lumber. This has been suddenly one of the hotter places to be. Like a huge breakout in wheat. Corn is just running away like it stole something. Like, I mean, it looks like at this point 700 on corn is almost money in the bank. And then you look at the beans. The beans have solidly broken out, and so you have a situation where the grains are actually doing very, very well. And it's funny because there isn't too many commodities that are like, I mean, yeah, copper has been relatively working its way higher, but this has been where in that commodity space there's been some real genuine strength. No comment?
I unfortunately I was bullish and then I didn't stay with it as much as I should have. But to me, it's feeling late in this party. To be buying it up here is these.
Oh yeah. No, I'm observing about the strength, but I mean, of course, there isn't much. There's not much asymmetry in chasing. Like, I mean, at this stage, okay, let's go back to corn. Yeah, I think corn can hit 700. Right, that's 40 points higher. But I mean, the move happened from 540 to 650. So you're at this moment 1 month into a 100 plus point move that has 40 more to go. There's not much asymmetry in that. So I agree with you in the sense that this just because it's been hot and it's been working doesn't mean it's a good buy.
Okay, I found it. I'm sorry, Patrick.
Yeah, go for your TJ.
Okay, so it had gone from March 4th of last year. It was 392 billion.
Right.
Within July, at the end of July, it was 1.8 trillion. Then it bounced around. It was 1.6 trillion on February 3rd. Okay, February 3rd, it was 1.6 trillion. It's basically a trillion now.
And you think it could go back to like
I think they're aiming for 700 or something. So they're not taking it right back down to where it was. So I think we still have, another couple $100 billion. Like we say that just like, just a couple $100 billion. So there's more to come, but the big meat of it has occurred.
Yeah. All right. There you go. You heard it from Kevin. So the what I wanted to talk about was this lumber chart.
Oh,
now you know what's crazy? It's got to be close to the top because the amount of Twitter memes on lumber, and the amount of lumber trucks that need police escorts supposedly when they're being transported, is so overwhelming.
I like the one where they said the guy's girlfriend says, "Take me somewhere expensive," and he's at a Home Depot in the lumber section. I think that's a good one.
But you got to think that at some point, with that amount of attention it's getting in social media, it's got to be late stages in this move. But okay, you're going to go back to your Jim Rogers thing where No,
like I'm not going to say that again. I've already told that story numerous times.
But
it's like it's a thin market, though, is one of the things to be aware of.
Look, it will not shock me if we print 1,500 or 1,600 on the upside of lumber in a week or two. But I think that this is going to one of these parabolic. The slope of trend line thing that me and you do all the time, right?
That you do, that I've learned from you. But yes, it is.
Like
we're putting on your tombstone.
There you go. But what you can see is the slope of these trend lines. It's like literally accelerating.
Yeah.
And usually that means that even though the price can certainly go another 20% higher from here, it's going to blow off at some point.
So we're close to it in time. Price is another matter.
Yeah. So you predicting one or the other. I think from a time perspective, it's close, but it can go higher still. So I want to go to some of the individual stocks just so we can not just talk futures. I was watching Amazon here. Amazon has been basically for 9 months like just in a sideways trade range. and it's kind of consolidating along its highs. And Kevin always says, there's this wise man I know, Kevin, that says no such thing as triple or quadruple tops.
There isn't.
And so with it consolidating along these highs, wouldn't it be interesting to see whether this is finally that moment where Amazon breaks out?
Yeah, doesn't it look a lot like Facebook did?
Yeah, I mean, there's a lot of even Tesla before some huge breakout back in the day, like. And well, I don't want to talk. Well, we could talk Tesla too, but like if you look at this consolidation right here, it basically that wasn't like 9 months. That was only like 3 months, but it traded sideways, and then when it finally broke out, it started to go. Now Amazon's has been like a prolonged one, but the question here is this the moment where it's about to break out and run for 4,000? Oh, it's worth watching. Another one that was interesting is Netflix. And Netflix has been in the same trade range, but is on the exact opposite end of where Amazon was. Right? Amazon looks like it's at the top in the range and ready to go, while Netflix disappointed. And I kind of look at it and think about the storyline, because in the end, I think that Netflix was such a huge benefactor of the kind of consequences of COVID, which is everyone just stays at home and they subscribe. It was impossible for them to have maintain the kind of subscription growth that they were getting. And so it was set up to eventually start disappointing just because they simply couldn't keep up those kind of numbers. I mean, is this where Netflix finally comes back down to earth?
I'm not sure. It was the Netflix and chill. Maybe everyone's doing the YouTube and screw. There's a whole bunch of them, by the way. I just went and looked at these. Hulu. Oh, I can't say that one. Actually, I can't say any of them. Anyways, I'll just let it go. But just Google Netflix and chill alternatives. I don't know, Patrick. I do think that Netflix was a trade that there was a lot of people in terms of the stay-at-home stocks, quote unquote. And then the other ones is the obvious ones, Peloton. And also Zoom.
Yeah, Peloton.
And both of those look like shit, right?
Yeah,
and that's Peloton, a technical term.
That looks like a very bearish chart, and even Zoom, when you look at it, just hasn't been able to get off the mat
that
at
looks
all.
Terrible.
Yeah. And touching on some resource stocks, I want to move on here. So here's a chart on U.S. Steel. And U.S. Steel's been following this nice higher highs, higher lows. It's in this kind of resource basket that thing, and like a little attempt to break out. Is U.S. Steel ready to go? I think this is going to be an interesting one to watch, whether or not we get the next move there. Another one that I thought was really interesting was touching on these energies, particularly this is the XOP, which is the that Spider oil and gas exploration and production one. It's a little more volatile than the XLE, which has all the big majors overweight in them, right? And this thing, while oil has more or less been consolidating sideways, a lot of these types of energy plays have been outright dropping. I mean, the top to bottom, the peak to trough drop was 22% in these energy stocks, while oil was really flat. And I'm wondering whether this is now overdone, like whether the selling, first of all, the move higher was extraordinary off the lows. But with this type of a dip, are we approaching a buy on dip opportunity on these energy names? I think that's something worth watching as well.
I like it. I'm going to put that on my list.
And the last one I wanted to touch on was the airlines. And it's interesting because that was on the kind of economy reopening. We could also put on cruise ships and casino stocks and hotels and whatever. Like
no, those are those are the opposite of the stay-at-home trades.
Opposite the economy reopening trades, right? And so JETS is the global airline ETF type of thing. And what's interesting here is that was also had a really nice run in the post-November period, and very similar to like these energy stocks. This has been more or less pulling back for the last month or 6 weeks, and it'll be really interesting as to whether this is going to be a turnaround here or not. It's something that I wouldn't mind following up with when we're looking at some charts in the coming weeks. Anyway, that's all I got, Kev.
Okay, before we go, I found a more, the PG rating of all these things, of alternatives to Netflix and chill. I'll just go through them. Hulu and Hang, Takeout and Makeout, HBO Go and Merlot, BuzzFeed and Proceed, and then here's mine: Netflix and nap, or Amazon Prime and bedtime. Thanks, Patrick.
Okay. Anyway, that's enough.
Okay, Patrick, that was real smooth, by the way, bud. For this week in trading history, what do you got?
All right. Well, listen, let's talk some gold. It was
because we don't talk about gold very often.
We don't talk.
Neither of us likes it.
And so, but it was April 20th, 1933, when the U.S. officially goes off the gold standard. So it was on April 20th that when FDR ordered Americans to turn in their gold in exchange for dollars and prohibit the hoarding of gold and the redemption of gold by other countries. Investors, though, and this is the interesting part, heavily bid up stocks on the news. The Dow Jones was up 9%.
Wow.
On the day of the announcement.
I had no idea.
Yeah, and another 5% the following day in 1933 as well was the best year the Dow Jones had in its history, up 53%, followed by obviously another 38% rise in 1935. Now, obviously, first of all, it's important to note that we were pretty deep into a bear market at the time. So it's easy for an index to be up 53% off the lows. But it's interesting that it was them going off the gold standard that actually started the turn.
They didn't go off the gold standard. They made it they made it so that the individuals couldn't hold gold. And ultimately then it would allow them to devalue against gold.
Yeah. And so although that
and I guess sorry to interrupt there. I guess that's what the market smelled. Because the market realized that this next step was for them to revalue gold higher, which would be inflationary and send stocks higher.
So interesting other little facts, though. So it would create violent moves in the currency and commodity markets. The U.S. dollar would be down as much as 10% in the day that followed, as well as silver rose 12% from like $28 up to $32. And so there was some really big whipsaw along the way. And so just other really interesting things that once the Great Depression hit with full force, countries had abandoned the gold standard and so when the stock markets crashed in 1929, investors began trading in these currencies and commodities. As the price of gold rose, people exchanged their dollars for gold, and it worsened so that when banks started failing, people began hoarding gold because they didn't trust these financial institutions. Because back then that gold was collateral in there, right? And so the Federal Reserve kept raising interest rates. So even though there was an extraordinary bond bull market throughout the 1930s, that little window of time following the 1929 period up until this moment, the Federal Reserve was actually raising rates to attempt to make the dollar more valuable, to dissuade people further from depleting their U.S. gold reserves. So they were raising rates into a depression. Now that wasn't the trend over the decade, but that was
like
certainly
all those hard money guys that were so happy about that.
Yeah, but it made the cost of doing business more expensive, and those higher interest rates caused many companies to go bankrupt, or at least became the excuse that many used for that. But obviously, a month earlier, before this big event, was March 6th in 1933, when that newly elected President Franklin D. Roosevelt closed the banks. So that was the big bank closure in response to that run on gold reserves. But by the time banks reopened on March 13th, after that little bank holiday, they had turned in a lot of the gold to the Federal Reserve that they had, and they could no longer redeem those dollars for gold. So it was a really interesting transition period that happened during that 1933 period.
Well, thanks for sharing that with us, Patrick.
There you go. So let's go on. It's because it's my favorite time.
Oh, yeah.
What time is it, Kevin?
Skin in the game. It's time for me to lose again.
Woo!
Well done.
All right. So, skin in the game. So, Kev, we had a bet, right?
Yes, we did.
And you tried to bully me.
I did, and the gods punished me.
Yes,
The
the
gods
market
were
gods.
like, you tried to bully Patrick, and this is what you get.
And it's intuitively, I was like, you know what? It was worth the risk of losing the stake just to draw a
Well,
line.
you were also up, so you were like, okay, I got a stake already. Now
I already got
two.
a stake. So,
So
worst
actually,
case,
I was
if I-
thinking about this, and I was thinking instead of you having 2 stakes, which I can see you doing that because you do like your steak, and who doesn't?
Right.
But I was thinking that maybe we could get Lena to come, and I'll buy you both steaks, and that would be very honorable and gentlemanly of you to do.
Yes.
So that
would
she
be
can
good.
try
look
the
at,
wagyu.
look
the
at
wagyu.
you. Look at you, like making me give away my prize.
Well, you were the one that made me put the Florida
you're the
piss up
one-
on our bill.
Oh, that's true.
So we're
actually
even.
we're it's now going to be called like the Florida market muddle, right? We're not allowed to call it the piss up.
The Americans don't like they don't know that. So the
We're
yeah,
going to call it the muddle.
the muddle.
All right.
But,
But,
that's the other thing is we don't want to confuse people with the real piss up. That's right.
the real piss up.
Yeah, you're absolutely right. We're no longer calling the Florida one the piss up because that is not the piss up. The piss up is when
Is it-
we finally open our economy and people
And
can
we're
fly to
gonna have it
Canada. Hopefully it's
Yeah.
this year, and everyone comes. So
Right.
the one
So,
in Florida is the market muddle with Cuppy and Patrick.
Yes,
Okay.
it's going to be a good one. So I think that's a reasonable proposition. I'm going to reserve the right to think about it, but I do think that's a great idea.
I don't think you should be
do.
allowed to do that. Lena, what do you think?
I agree with Kevin.
Yeah, see, there we go.
Fine, all right, fine. I've had my prize given to Lena. Fine, okay, but so let's. By the way, Lena,
Yes.
what's the score between our bets?
So, from day one of all the bets that you guys have settled, you guys were tied.
We
last
haven't
week,
netted
so-
any of these. Remember, all
Yeah.
bets have
but
to be.
we've been
delivered.
keeping a tally.
Yeah.
Yeah.
So Patrick is now 1 ahead of Kevin.
It was
Woohoo!
tied. It was tied.
Boom!
and we
It
went
was tied
ahead
last
in a
week, yeah.
big
Boom!
way. It was
And
an
with
overtime
2
goal
stakes.
on the. Yeah.
With 2 stakes in under my belt.
Well, Patrick's
and I've
gonna have
got
to
the
watch
lead.
his cholesterol.
I'm totally goochering this by
You
now,
are.
like flaunting.
But anyways, well done, buddy. You
All right.
called me
So-
on my bullshit move, and you won. And the gods,
Okay.
and not only that, you let me hang myself because I picked, which is
Yes.
like which is the worst part of it. Like when you pick, so you completely let me hang myself. I picked, and I picked the wager. I did it all. I completely deserve my own having to buy 2 Wagyu steaks.
Yeah. No. Well, I mean, you fell
Anyways,
on
well
your
done.
own sword.
Well
You
done.
fell on your own sword. Okay. So why don't you quickly tell everyone the rules, and then let's make a
Okay,
new bet.
Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. We haven't said it in a while. I'm going to say it this time. Duke and Duke, which is a crisp $1 American bill. Then it goes up to a pint of beer, then a burger bet, then a pitcher, a case of beer, affectionately known in Canada as a 2-4, then a bottle of wine, not a box, with a $100 limit, and finally the big prize, the steak dinner. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions, but there will be shaming of getting prizes given to Lena.
There you go. Okay. So Kev, it's time for a bet.
Okay, what do we got for me?
You know what? I decided I need to choose something incredibly neutral. At least something that's the price is very neutral, so that we're not dealing with like little overbought or oversold market. And so I had to choose oil. All right, so actually let's look at specifically the June contract, right?
Are you sure June,
Yeah.
Oh yeah, June will be good for next. Okay, yep.
Yeah.
I'm with you.
It's this April right now. So we're the June. We're going to use the June contract, trading at 62.14, right? And so if you look at the high and the low of oil over the last since March, right? It's been about a $10 range, and we're literally in the dead center of it. $5. Like we are right in the middle of this horizontal triangle, like whatever you want to call it, and we're just it's a straight up over under, buddy.
Oh. I like it better when you get to pick.
Yeah, no,
I'm gun
like
shy now. I've lost a stake twice now. I'm gun shy, and I feel like whatever I'm going to do here is going to be wrong. I'm not doing well on the skin in the game. I gotta get one. Okay, so let's see. Over under on crude.
42.14, the close today.
62.14.
Friday's close. The 62.14.
Don't worry, but it's not like you deal with numbers for a living or anything. Okay. I'm going up.
All right. I guess I'm
Trend's
taking
higher.
down.
I should stop rethinking. I should just, trend's higher. It's above its 200.
So are you going to try to bully me here?
No, I am not. I am not doing that at all.
What's the bet then?
I guess we should if I had it my way, we just keep going with pitchers to go for the actual piss up.
All right.
Pitcher it is?
Pitcher it is. Pitcher it is. I'm good with that.
Okay, nice.
I'm good with that. All right. So pitcher of beer, Lena. We'll just mark that down. We're talking June crude oil contract, Lena. 62.14. All right. So it's time for no stupid questions, Kevin. Only stupid answers.
Yeah. Well,
this is where we're going to invite Lena on and take us through some of our listener questions.
That's right. Let's see the first question here. Okay, so the first question of the week. Evoking history in this era of inflation, can you discuss Carter bonds, named after the inflationary 1970s U.S. President Carter? Why were these special U.S. Treasury bonds issued in German marks and Swiss francs?
Okay. I was kind of flabbergasted because I didn't know about Carter bonds. Did you, Patrick?
No.
I had no idea. So I went and looked this up. And in essence, Carter bonds were 2 to 4 year notes denominated into marks and Swiss francs. Having trouble speaking today, and issued publicly by the U.S. Treasury in German and Swiss capital markets between late 1978 and 1980. And they were issued to supplement foreign currency resources for U.S. intervention. And I think this is actually a great question, given what Vincent was talking about earlier in terms of the foreign exchange market. We've grown accustomed to the foreign exchange market being quite boring, where there's not much going on. The governments don't, intervene, and it just ends up being very, very staid. But I remember back in the day that the Japanese banks would be, or the Bank of Japan would be in there intervening all the time, and it used to be a lot more action in it. But if you think about it, if you were trying to buy dollars, as a U.S. central banker, and you're trying to buy dollars, and you need to sell another currency, if you don't have any foreign exchange reserves to sell, you can't actually buy your dollars.
Right.
So what this was an ability for them to have currency to sell against, so that they could go and they could hit a bid in the Swiss francs, and so that they would be able to buy their dollar and support it. And it had to do with once they got off the gold standard, there was all sorts of dollar weakness, and it was basically, nowadays a lot of it is done through swap lines and things of that nature. And they did have swaps. When you go through and read the history of this, there were swaps, but they ended up getting too big. So what the U.S. government did was that they issued these Carter bonds in another currency so that they would have that currency to sell if the U.S. dollar was weak.
All right. And that's the story of Carter bonds. I like it. All right, Lena, next.
Dear Patrick and Kevin, I watched the Market Huddle from the start. Great show. Now I also have a stupid question for you. The natural gas ETF UNG was in the past a bad performer in contrast to nat gas futures. Is that how you read it? As far as I know, because of rolling of contracts. When I now compare the performance of UNG and nat gas futures on TradingView, the charts are almost identical since the beginning of the year. Then I looked up the holding of UNG, and this is not what I expected. A large part of the holdings are next to commodities interest, treasuries, and cash. Why so much treasuries? Could you give some light into this picture? And does UNG behave now similar to USO because of more than one contract month? Did they solve the problem? Thanks a lot for your answer in advance.
All right, Kev, before you get, because I know you're going to want to talk about this a little bit as well, but let me start off by just showing the charts of the UNG and as well as the continuous nat gas contract. So the UNG, this is the ETF to represent natural gas. So it's been just woeful. It's just if you actually, more important, let's put it on like a weekly or a monthly chart just to show how brutal of a product this is. Like like from 2000 to 10, right?
It's like VXX.
It's exactly just a brutal product. While when someone looks at a continuous contract of, let's say, natural gas, it doesn't look anything like that. It's far more boring, sideways, range-bound, and doing nothing. And one of the reasons that this problem existed, and it existed as well in the in the USO, which was the crude oil one as well, was because they were rolling futures contracts. And so what I have here, just a chart, quickly shows the term structure of natural gas. Showing that how you're rolling forward, up and down the contracts. It says each of these little bumps is the seasonality being priced in to natural gas, and so a lot of that bleed is because of the natural contango that exists in the market as they're moving. Now, this is with this context, you can go ahead and explain.
Well, that's pretty awesome. Why. You explained it well. And so, in terms of the actual holdings, when you own a future, you don't actually take delivery of anything. It's merely the obligation to deliver. And given that they are continually just rolling futures, that is the quote unquote asset of the company. When they get all that cash, they need to do something with it. So they invested in treasury bills because they need to make sure that it is safe.
Short-term, mostly.
And so I'm pulling it up right now, and when I pull it up, I see that they have 50 million. Is this? I guess it's not that big. 50 million in treasury bills, and then they have actually a Morgan Stanley liquid government institutional. That'll be somewhat similar to a treasury bill. That'll basically be a money market instrument, and so almost all of the assets are sitting there in cash equivalents. And then on the other side, they have 9,530 of the June natural gas futures. Now, the other question this listener was asking is that was there any problem in terms of the contracts having, I guess basically the issue was in USO was that if you had one contract and it went to a negative value, that it would become a liability, and that was the real problem. It looks to me like they haven't worried about it, and they haven't gone out the curve, and they've left it at the front month. They have not worried about the same problems that they had with the USO. The USO was strange because at a certain point it went negative, and if you own that negative month, that your actual, what you thought was an asset becomes a liability, and you could theoretically zero one of these ETFs.
Yeah.
And so the reality is they have not worried about it with UNG. I guess they're hopeful it's never going to go negative.
Well, they've just destroyed so much of the investor capital that there's nothing left to. They can't move the nat gas market anymore.
Patrick, I love it. The fact that you're so bearish and talking about them destroying the capital means this thing's headed higher. Okay, what do we got for the next question?
I can't believe you just said that. Don't listen, listeners. Don't listen to him. This is an awful product. It's anyway. All right. So final question.
Final question of the week. This is my kind of question. Can you explain currencies to me like I'm 5? I understand the whole strength and weaknesses of a currency and how that may affect imports and exports over the long term, but I struggle to interpret currency movements and what the implications might be outside of that. If you wouldn't mind sharing, what are a few currency pairs that you watch and what signals do you get from them? Thanks for the help.
All right, Kev, I'm going to let you do the heavy lifting on this one. But, I mean, the most important thing to take away at this stage is we remain in a U.S. dollar-centered world, which is where almost all global trade, or a very large portion of global trade, it continues to be settled in U.S. dollars. And so the U.S. dollar and the movement of the U.S. dollar has huge impacts everywhere all over the world. And now, obviously, the world is slowly trying to transition off of that, and that's a theme that a lot of macro traders have, but it all really, in my mind, is still anchored off the U.S. dollar until it stops being the world reserve currency, or at least it's not as important anymore. And so, really, in my mind, the biggest macro is, and that's why they're called the majors, is all the biggest economies in the world, how their currency is trading against that U.S. dollar, and that's what we call the majors, right?
Well, and trying to address kind of certain parts of this question in terms of the listener struggling with how the strength or weakness of a currency and how it affects imports and exports over the long term. Imports and exports are actually part of the equation that goes into deciding the value of the currency. Yes, a country can influence that by changing, how much their monetary policy and even their fiscal policy. But it's a complex kind of equation. And one of the things that always makes me not mad, but makes me kind of shake my head a little bit is people that always assume that the only thing that's driving currencies is interest rate differentials. So they see, a country having, 25 basis points or 50 basis points more carry, and they assume that means that it's going to be stronger. So, for example, Patrick was talking about the Canadian dollar earlier, and he was talking about the fact that it was this, Bank of Canada is one of the most hawkish central banks out there. And so therefore their currency is going to be 25 or, 50 basis points tighter in terms of, their funding will be 25 or 50 basis points tighter. So someone that is investing in Canada will earn that extra over, the U.S. But my question is, look at how much volatility is in the currency market. 25 basis points, that can be eaten up in an afternoon in terms of the movements of this currency. So I'm always at a loss when people ascribe too much value to the interest rate differentials. And the reality is that there's capital flows, basically financial flows, can occur for a variety of different reasons. People can come and buy Canadian financial assets because they're actually, attractive. They think that they're going to earn a good return for whatever reason, whether it be, the stock's going to do better or they have they're going to invest in a company. And so that's those kind of flows, those larger, longer term flows are important. And that is one part of it. And the other part of it is that the import and exports, people can buy currencies to pay for goods that they're selling. So Americans buy Canadian dollars to pay for, the maple syrup we sell them. And, what else do we sell? Do we sell anything else? We're not very good at selling stuff.
Just stop right here.
Yeah.
Lena, can you hop on here for a second?
Yes.
Now, if you were 5 years old, give Kevin a score 1 out of 10 on what he just did. If you were 5.
Okay, I'm sorry. So let's go back. Let's go back. Okay.
No. Hold on, Lena.
Okay. Well, I get a 0.
You score him.
Maybe 2. 1.
He's too sophisticated for a 5-year-old, that's for sure.
All right.
Yeah. No, I'm used to the 5-year-olds. They've been studying the markets a lot since they've been at home. Anyways, in terms of currencies, step back and think about the actual flows that occur in a currency. Meaning, think about people that are buying and selling it and the reasons that they might be buying or selling it. And it's not just interest rate differentials and trying to arb, getting 25 basis points more. More often than not, it's in real flows, meaning, buying and selling currencies for goods that they have to pay for, or, imports the other way. And then in terms of the financial flows, yes, there is some hot money that moves and does chase interest rate differentials over the short run. But most of the money that is flowing in and out of a country are people that are taking a longer term viewpoint of it. And it will be a country that's, like a pension fund that decides they're going to invest in Canada because they think that the opportunities are good, and they'll allocate and buy money for those things. But there's lots of different flows. Just be careful. I guess the truth of the matter is that there is no one answer in terms of explaining what moves a currency and why it goes, up and down.
Great job making it simpler. Okay. But what I was going to just add, just to finish the question, was that I said there's which currency pairs, because the trade-weighted impact of currencies is so important. The two largest economies outside of the U.S. being the Eurozone with the euro and the renminbi with China are arguably two very important currency cross. Japan's currency as well is relatively important. So, if you're categorizing them by which ones are the most important to watch, those would you agree with that?
I'm going to jump in there. I'm going to actually say Japan is the number one to watch in terms of if you're a trader and trying to figure out flows. Japan, I don't know if it's because they have so much savings and they end up being a disproportionate amount of affecting the American flows. But if you said to me you could only watch one pair, there is no doubt in my mind I would choose Japan.
And no doubt in my mind, I would choose the euro, but that's what makes a market. Okay, so let's, Lena,
Yes.
where can they submit their questions?
They can submit questions to nostupidquestions@markethuddle.com.
Only stupid and too long answers. Right?
And
not for
there's
5-year-olds.
definitely no 5-year-olds listening to the show. We've determined this at this stage. All right. Anyway,
Okay.
let's.
Thanks for tuning in, folks. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena's there, and she's I love your gifts, Lena. Like, why don't you hop on there?
Yeah,
Your
I'm
Twitter
here.
game is just outstanding.
Oh, thank you.
I
Thank
really
you. I'm
enjoy
having
it.
lots of fun.
Yeah, no, it's good. So make sure everyone give Lena a shout out. She gets tired of talking to Patrick, myself. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And I am going to go back. Instead of telling you about iTunes, the fact that you should rate and review us there, I'm going to read one. I like Rick111111. He says, these guys are great. Awesome insights and always entertains while providing new insights. Only thing is, you want to set the speed to 1.5. And their BTC, which even I know that's Bitcoin, views are so boomer. Nothing pisses a Gen X off more than calling them a boomer. So well done, Rick.
Yeah.
It
stings.
Although,
it's like a knife into the gut.
But the reality
right?
is because we're Gen X, we don't do anything about it.
Yeah.
Like we're just like, okay.
No, we're just
But
gonna
it
go have
does-
another
It
beer.
does sting.
I'm
though.
just gonna have another beer. I'm gonna drink it off.
It does sting. It does sting. Anyways, you can Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, or you can follow me at bigpicturetrading.com. Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.substack.com. And listen, you can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. So this beer.
Yes.
I didn't like it.
So I love their marketing slogan. Like if I had to pick something, that I'd be like, oh God, that's my marketing slogan. I love it, but the beer is terrible.
I liked it.
Did you?
Yeah, I finished it.
Oh, well, I'm struggling to get it down. It tastes like
Well, I didn't struggle getting it down, but am I eager to
it's
go
like
and buy
someone
a
took
case?
beer and then put one of those those Macintosh toffees that we had when you were kids.
Oh, yeah, I liked it. That's why I
Yeah.
liked it, I think. It was
You
nice
know-
and sweet.
Do Americans have that? The Macintosh toffee? Is that like a British thing that we've imported?
I have no idea.
Yeah, I don't
Probably.
know.
Like where you
I know, but
slam it down and then have the chunks?
Yeah, I don't know if that's
Yeah.
available in America.
You know what? Like
It is-
I
it
don't
is
want to.
British, by the way.
I'm not gonna say that this was a horrible beer, but it's not something that I would regularly want to drink.
It's not a
It's-
crisp, summer sort of
Oh, it's
beer.
definitely not a summer
No.
drink. This is a winter pub beer more than anything.
It is kind of meaty. I agree. It's like
Yeah.
if you like it tastes like there's like 7,000 calories in this. Okay, I'll go first. I'll set the tone here. Obviously, the slogan is "Save them from a terrible score." It's still not going to be good. It's going to be 7-0. I know that's an amateur score. Portnoy would get mad at me, but I'm going 7-0 even.
All right, Lena, go for it.
I would give this beer 8.3.
Well, Lena loves her beer.
Yeah.
Well, this is the only time I drink, right? So-
Well, it's not like I drink it
Just
at another time
watch.
either, but I'm just not as sophisticated as you.
Me, on the other hand, I don't stop drinking. No, just kidding. But I'm gonna give it like a 7.3. I don't like 7.5 being my midpoint. Like it's below my average point.
Okay.
It's not horrible. I don't want to shit on this beer, but I'm not gonna give it above average score. And so that's where I land. And it's done. It's said. All right, where are we going?
I don't know. Did you guys watch anything?
No.
So I watched something. I'll tell you. I was waiting for Made for Love to come here because it's on HBO Max, which we as Canadians don't get. Did you know
Made
that?
for Love?
Made for Love. We don't get HBO Max. Did you realize that?
No,
I didn't even
know.
know that existed. What is that now?
Oh, like HBO Max.
HBO on steroids?
I don't know. We just get HBO Min. I don't know. I have no clue what HBO Max is because we don't get it. But anyways, interesting. They made this, and then for some reason HBO Canada doesn't pick it up, but Amazon picked it up and put it on there.
Oh, okay.
So it's got. Look it up, Lena. Like you might know the lady there. That's. Let's just look at what she's in. It's not.
Made for Love?
Yeah, Made for Love.
Oh, this lady. I don't know her name, but I've seen her in a couple of things.
Yeah. So she's in some When I Met Your Mother. Anyways, it was an interesting concept. I did not love it.
No, I don't think it's not the same lady.
It says that. I don't know.
Is it?
It's not like she's not a main star. And let's just look here. She's in a Family Guy.
This is
The
not,
Wolf of
this
Wall
is-
Street. She's there.
Oh.
She's just one of those actors that's. Yeah, she's
She looks
definitely.
like a- yeah,
she's in
she-
2 seasons of How You Met Your Mother, so she must be.
Oh,
She must
I
be
thought you
somebody's
meant-
love interest or something.
yeah. What's this about?
She's in The Sopranos. I can't remember that.
She's in The Sopranos?
Yeah.
I don't remember her being in The Sopranos.
She was probably 12 or something at the time. Anyways, it's about a woman that goes and ends up at a Google, like it's supposed to be Google, obviously. She marries this tech guy. And I don't want to give too much away. I don't know. If you're desperate, it's not bad. I wouldn't call it good, though.
If you're desperate, it's not that bad.
I wouldn't call it good, but I wouldn't
So-
call it bad. I'm not going out on a limb.
Without it being my choice, a movie that I got stuck watching last week was the Rocky Horror Picture Show again.
Oh, that's awesome.
It's not the first.
Again,
It
you're saying.
wasn't the first time I saw it.
Yeah, let's
but
be honest.
but it was a
Patrick-
blast from the past.
Patrick got all he put on the
Oh,
brassiere and the thing, and he.
Oh
and he-
yeah,
and
no,
he
I was
carried it out.
right into. Oh, I was right into
I
it. Me
could-
and Tim
I-
Curry.
How much
That
will
we-
you
it was-
guys pay for that?
No, we're not going there. If I lose a bet that's that bad, and the images end up on
They
Twitter
used
with
to
that.
do that at Bloor and Bathurst Theater.
I know, it's
every
awesome, eh?
Halloween, and you take toilet roll papers, the toilet paper rolls, and
Yeah,
dress
the
up
water
and-
guns and rice and
Yeah.
all the whole wasn't it like toast or something you're supposed to
Yeah,
like.
you have to bring a whole bunch of stuff with
So,
you. But
It is a cult classic, that is for sure. Like I think that was like the, but you know what? It's the songs that make
It's
it.
a great. Yeah, it's
damn
awesome.
it, Janet.
Yeah. So I got to tell you something though, Patrick. You came up on in my on one of my posts. So I have a post, and then we have the really great discussion at the bottom. And so on what day was this that I wrote about this? Anyways, I wrote about it was called Paper Bag Pause was the name of it, but I had this great picture. And we can, if you're interested, it was this woman, and I wrote a little caption. I said, "Now, no other way to say it. We're at the stage of the cycle when things get weird." Okay, and then we can all do it together. Go to batheinmymilk.com.
Okay, hold on a second.
Bathe, like BATHE-INMIMIL. Okay, so this woman, you can pay her. And in here, I'll read it out. I'll read what she says. Offered to men only. Soy, almond, or traditional. Use my sponge. I will watch you. And what's great is go to the 7th one. The 7th one is by far the one that makes me laugh the hardest.
This one?
Yeah? No, 7. Keep going. That one. Go back. Look where she is.
Oh, in the window.
Okay. So it's pretty funny, right? And so my readers were...
Kind of creepy at the same
It's creepy, but it's kind of hilarious. Like, there's no
Yeah.
doubt about it, right? So then we started talking, and good old Morris is there, and he's always one to. It's actually where I got to know Morris originally because he was always making comments. So he put in a comment. I just got to grab it here. Let me just see if I can get it. And here we go. So Morris quickly said, "I'll pay $1,000 for you for a picture of you doing that." Okay. So then I said, 2 more zeros. I think I'd do it. I'm not that proud. Okay. And he says, "Now we got to market 5,000 bid." Okay. So we were 5,000 at 100,000. I asked if we could tighten it up a little bit. And then the guy says, I think the inside market, Morris says, I think the inside market is $10 to $50. Patrick would do it for 50. And then I said, I think Patrick would pay the $50. See, you gotta have to read, Patrick, because you're getting involved here. You're missing out on all this fun.
Bathing in milk is actually really good for your skin.
There you go, Lena. Lena, you know what? You should do this, Lena.
Not in that lady's back.
No. The other way. You should offer it.
Oh my God! And you could buy an advertising spot here at the Market Huddle. We'll
That's
put
right.
you out with
It is the
a
weirdest
30
thing ever.
second.
Isn't the world just a weird place?
Yeah.
Like, just honestly, and she's so serious
Wait,
about it.
This is not for real, is it? Like,
I'm
it's
pretty
not
sure
for,
it
like,
is.
some sort of a
No,
sort of like an installation art or performance art sort of.
I don't
thing?
know, Lena.
It's not.
She looks pretty serious about it all, though. She looks like she takes her craft very seriously. Although her cleanliness in the bathroom is a little
Yeah,
septic. Like, I'm
a
looking
little
through
bit.
here and it's getting a little.
It must be a shithole, like with a crooked floor, like the
And
angle.
why
of
is
the-
she in her like nightgown?
That's
Like, it's
that's
just
part of
weird.
it. She'll watch you. Anyways, weird, eh?
Yeah.
Anyways,
Well, thanks, Kevin. I mean, you've thrown me off. I don't know where I'm going next. It's a.
so, like, this is what happens when your premier locks you in your house.
Yeah. By the way, how do you guys feel after your vaccination?
I'm feeling all right now that I'm drunk.
You know what, Lena? I'm fine. I just find that I think I keep thinking about sum equals A11 to B52, and all these Excel formulas keep going through my head.
It's
I asked Patrick how he was doing earlier. He's like, you know what? I don't know. I'm not sure if
hey.
I'm feeling okay.
At
or
the
not.
time of recording here, I'm only 4 or 5 hours into this. I'm still we're trying to figure out whether it's a placebo thing or whether or not there's a real. I think a lot of times you get side effects just because you think you are. It's just like the Huddle. Like I always, after you read all these Huddle side effects, it's like, man, I think I got that. It's
like when doctors are in like medical school.
yeah.
And they literally tell them, like, you do not have these things. Do not worry about this. And then they tell people, and then they, even though the doctors told them that they don't have it, they all think they have it.
It's true though, right? Like, so you got blood clots if you got like a sharp pain in your head. Well, I got sharp pain in my head. It's like,
Yeah, I hear you. I don't know. My wife just told me something. It happens 4 to 20 days later, so I'm about to hit it.
Well, my parents said they didn't feel anything until after the second shot.
Really?
So, yeah. But they got the Moderna.
They got the real one.
So, yeah.
The real one,
We'll
yeah.
see.
Yeah.
I'm all alone, so I'll just be like, I'll just die alone. Someone will have to come. Someone will have to come get the cat. I'll tell you where
You don't
I
show
better
up for
tell
the
you. I'm going
next
to tell you where the
Huddle.
key is, so that because I worry about the cat. I don't want her to like.
Not the dog, but
Oh
just
my
the
God.
Oh, the cat and the dog.
I
too.
can't believe we're going here in the
I wouldn't want the dog to eat me.
Oh my god.
Oh my God.
That happens.
Did you have to go there?
I'm just kidding. I hopefully I don't. Although I do worry about it, like because it would be a while.
All right, I'll tell you what. I'll text you every 4 hours
It's all right. I do
and
not
if
wanna
you don't
get-
respond,
I do
I'm
not
gonna.
wanna hear from you every 4 hours.
I said text.
Doesn't matter.
You just have to like do a little smiley face response or something, right? Like you can even just do like the bracket for
I'm
a
gonna
smile.
give you a
like-
week if you don't show up for the huddle. Next
That's right.
week, then
If
I
I'm
know.
not there next Friday, come feed the dog.
Yeah. Come and save the animals.
The cat.
Oh
the
my
cat.
God.
Good news is the cat. Did I tell you guys the cat had like some sort of? It kept licking itself, and I had to wear the
yeah.
cone.
Yeah.
Good
yeah,
news
yeah.
is I got some steroids for the cat. I roided her up, and now
She's jacked?
And she's jacked, and she stopped licking it, so I can take this stupid hat off.
Oh.
There's a cone, because the cone's annoying.
Yeah, that's super annoying.
Yeah. So, and she loved me when I took the cone off. I was actually surprised though that she didn't fight the cone more than I thought.
I think they just give up after a couple of tries.
Yeah, it's kind of like when you get married, you just eventually just give up. Like I give up. Whatever. Where are we going? Okay.
On that note.
All right.
Okay,
Well, it was a good
Lena,
show.
we didn't ask you. Did you have anything exciting go on? Any shows you watched?
No, I'm on a rerun binge.
Yeah.
I actually was watching 300 again.
Ooh.
Oh,
Nothing like watching bunch of 300
A bunch of
ripped
muscles.
men in loincloths running around.
Nice.
So that's where I'm at.
Is it the main actor's like that Gerard guy, right?
Yeah, Gerard Butler.
Yeah.
Yeah, I didn't know that this movie came out 15 years ago.
Yeah, you
I
know
had
what?
no
There's a
idea.
whole
They
bunch of
could-
things like that you go and you're like, when was that? And you're like, holy shit.
Yeah.
Like, when do you think
Yeah.
Friends was? Like, how long ago was Friends, Patrick?
Oh my God, 1992, 1993,
What?
or something.
Yeah.
In the 90s?
Yeah.
Yeah, it was in the 90s.
Yeah, Friends is going to be like.
Oh, see, I would have guessed like 2005.
Yeah.
Like, my
Here,
God.
let's look. I'll
I'm-
bet you that it was by 2000 was over. Let's look here. Oh, no, 2004 it went to, so I was wrong. 94 to 04.
Wow.
But so, you know.
Oh, and by the way, in 300, I did not know until I watched it again this week that Michael Fassbender's in it. Do you know who that is?
Yep.
Magneto from the new, X-Men movies. I didn't know that he was in that movie before
Oh, yeah.
until recently.
There you go.
Interesting.
I like it when you find out guys that are in it because they weren't very big and they like literally are like the waiter. Well, there's Brad Pitt. He's the waiter. Well, not Brad Pitt, but you know what I mean, though, right? Like you go and you find roles that people
like
were
a
in,
really
and you're
big
like,
name
what?
actor now, and then you're like, wait a minute.
Yeah. It's pretty funny, actually.
Yeah.
Or those guys that are just in every movie and they never get the real role, and they're just like, you don't even know their name. You just know that that dude's in every movie. He's always the bad
But you know
guy.
what? That's probably good because it's like you're recognizable, but nobody really knows your name, so you still have your anonymity, so to speak.
Yeah,
you
you
have
can
your
just
privacy,
get a
you know?
whole bunch. You just churn them out. You need a bad guy that's gonna get killed in the fourth scene. I'm your guy. That'd be me. Like just like a complete and utter like just workman, kind of like like the third forward. The third forward, the grinding line, or is that the fourth line? I don't know. But the grinding line, like that's what you
The
got.
third line, not third forward. Third line.
Yeah, the third line, the whole grinding line.
Yeah.
Oh well.
I hear you.
Anyway.
I hear you.
Patrick
Makes sense. I didn't know.
Okay. Well.
Anyway.
Okay, on that great note, everyone
Yeah.
stay safe and
Yeah, good show.
we'll see everyone next week.
All right. Cheers, everyone.
Bye.